Hello, I'm Rick Schumacher with LBM Journal, and I want to thank you for joining today's webinar, Safeguarding Your Growing Wealth, Key Strategies for Protecting Your Assets. If you've experienced increased profitability through the years, it's likely that the value of your business has also increased. If you own the real estate where you operate, chances are the property is worth many times what it was purchased for when the company was founded. The combination of these non-liquid assets poses a challenge for protecting your net worth and creating sustainable intergenerational wealth. Our star of our webinar today is Sam Brownell. Sam is founder and financial advisor at Stratus Wealth Advisors, who is also the sponsor of this webinar. Sam has been a financial professional since 2006 and formed Stratus Capital Management in July 2013, which has since grown into Stratus Wealth Advisors, to provide goals-based financial planning and investment management to individuals, families, and independent business owners. As the firm grew, an increasing number of independent business owners sought Sam's advice on their short and long-term planning needs, including valuation, tax strategy, business continuity planning, and succession planning. So in 2019, Sam obtained a CVA certification from the National Association of Certified Valuators. So CVA is Certified
Valuation Analyst, yeah.
Boom. In order to better serve the valuation and succession planning needs of his independent business owner clients. You can learn more about Stratus Wealth Advisors at stratuswealthadvisors.com. A couple of details before we get started. All attendees are muted, so you can hear us, but we can't hear you. If you're having technical issues, click the chat button at the bottom of the screen to send us a message, and we'll work to quickly address any problems. If you have questions for Sam, click the Q&A button at the bottom of the screen anytime during the presentation, and he'll address as many questions as possible at the end of the presentation. And lastly, we expect to be finished in about 30 to 40 minutes. We are recording this, and we'll send a link to the recording to everyone who registered. Plus, it will be posted on lbmjournal.com. And with that, I turn it over to Sam.
Great. Thanks, Rick, and thanks everybody for tuning in and folks for registering. We're happy to be here. At LBM Journal has a lot of great content, and we're pleased that we can be part of that. So let's dive in here today. And speaking of industries that have really exploded in terms of value, this is one, right? It's been a great last 3 years for most dealers out there. And then you add to that the fact that real estate is worth many times what it was when it was purchased, right? A lot of dealers own their own real estate. It might have been purchased 2, 3, 4 generations ago. And so we're talking about a huge increase in value that the current owners have to think about. You know, how are they going to treat these values? How does it get passed to the next generation? Is there cash flow to do that? And really, when we talk about protecting assets, a key is thinking about the illiquid assets, right? If I own a basket of publicly traded stocks, it's pretty easy for me to get the money that I need. But if I've got a business in real estate, I can't just go to that and all of a sudden take out $500,000 to buy a second home, right? I need to think through how this money is going to come to me, and then more importantly, how am I going to get the biggest net out of the sale or the transition of the ownership of my business. So let's jump in. Brief background here. I'm Sam Brownell. As Rick said, I have this CVA designation, Certified Valuation Analyst. It's for folks that do valuations of private businesses, independent businesses, just like everybody listening in today. And so our firm does the majority of our work in the LBM space. And so we do everything from business valuation to full-on succession planning. How do you make your company worth enough so that you can live off of it? How do you buy it out? What are the tax consequences? How do we protect what you've built for your family and future generations, which is going to be a focus of today? And then we can provide personal advice on financial planning and asset management to tie that in with your business goals. So we can really come in and help at many different stages. And so let's jump in here today. And so again, inheritance tax, right? This is a big one for this industry, big one for any independent business owner is, how do I keep the money that I've made? And from my family's perspective, how do I maintain that growth in wealth, right? The business was started, let's say, after World War II. Well, It's gone through at least one transition at this point, and it's valuable. It's much more valuable now than it was 70, 80 years ago. And so that's great. That's great for the family. But we want to make sure that that wealth continues to build and can be passed down without giving away needless money in a transition because we weren't thinking ahead. So that's going to be a huge focus. And it really is the idea behind succession planning, right? 3 to 5 years at least before you're considering a transition, do you really need to come in and start thinking about the plan? Because it takes a while to get these things in place. There's a lot of stuff to do. And we know everybody out there is busy, right? You're trying to run a business. So the planning part, you need a professional, but you also need some time to think about it because it's emotionally difficult and it requires some time to get everything lined up correctly. So here's what we're going to go through today. Real quick outline. These are some of the things we're going to answer. Funding the buyout of the business. How do we determine how sustainable that is for my business, right? We don't want to starve the cash flow of my operations just to buy out a departing owner. We've seen that happen. We've had folks come to us after an owner has left and they are really strapped for cash flow. And we don't want to have to go back and try to re-engineer a deal, right? We want to be able to set it up sustainably in the first place. Then thinking through real estate, because we know that a lot of the folks out there in this industry own the real estate where they operate. That real estate is in sometimes worth at least what the business is, if not multiples of what the business is worth. So how do we deal with that, right? That's not necessarily a huge revenue producing entity, but somehow we have to handle that asset price. And then let's talk about protection of owners, right? Especially multiple owners. And as you go through different generations, right? We can have people of different ages who have different goals. How do we make sure that each of their goals is being met? So let's jump into this first piece. I want to walk through some of these strategies for funding a buyout. And so typically, and this is something that's a little bit different for this industry, right? We've got a lot of people out there that run great, clean businesses. And by clean, I mean without a lot of debt. And that's wonderful. But typically when you're talking about a buyout of a business, there is going to be some type of loan associated with that, which is why it's important to A, know the value of your business, and B, analyze your net cash flow. What can you support? Is this something you could self-finance? Am I the owner willing to say, hey, if I sell my business to Rick, maybe I'll get paid out through future cash flows of the business. I'm confident that there's enough cash flow here that I can be paid out, but we need to know that. The other side is, well, I'd like more money up front. So maybe I have to have the new buyers go out and get a loan from a bank. Well, that loan has to be paid back. Do we have the cash flow to pay that back? Over what time period is that loan? So these are things that are really important. And one thing that we talk to a lot of dealers about now is this idea of a reserve fund. A lot of people are sitting on a lot of cash right now. More cash than you need to meet your monthly operating needs, right? That's what your receivables are for. That's what the inventory turnover is for. You might be sitting on $1 million to 2.5. We've seen a lot of balance sheets with close to 2 million or more of cash. It can be a good idea to create this reserve fund with cash on hand. Maybe it's a different bank account under the company name. Maybe you start drawing money out of the company, putting it in a separate LLC that's owned by the owners or the family that can be used as a sinking fund to help with a future buyout. Right? Making sure we're using our resources and planning ahead, really important. And then insurance, right? Do we have insurance for our key people and our owners? And this can be really critical. We're talking about an illiquid asset. If something happens to somebody, we're not going to be able to get liquidity immediately unless we have the right things in place. We've got a sinking fund, we've got insurance. And finally, it's about exploring your options. What are the options? A lot more and more, it may not be the kids, but are there key employee or key employees? Are there strategic competitors? Are you big enough to do an ESOP, an employee stock ownership plan? If not, you can accomplish many of the same goals through a worker-owned cooperative. And so there are tax benefits to the employee route. and we can talk about those a little bit more if folks have questions at the end, but you have to look at all your options. Right? Don't just get locked into one or two and then be disappointed if they don't work out. So this idea of a sustainable buyout price, and the reason that we say sustainable is because we don't need or want the owner to be extractionary. Unless you've got a third party, you're a firm that's running, 12, 15% EBITDA margin, you've got a really good third party buyer that may be private equity backed that can pay, then yeah, take them for all they're worth. But for the most part, our job is to try to keep independence independent. And the way we do that is to make sure that every stakeholder at the table is going to get what they need, right? The outgoing owner, the incoming owner or owners, the employees, the customers, right? Everybody, all these stakeholders have an important piece in this, not to mention the community, right? Because we've got people who work at the dealer who use the local accountant, they go to the dentist, they go to the doctor, right? There's a lot of money flowing around in your community. So how do we make this sustainable? So let's look at a couple examples here. Here's a hypothetical dealer. We're assuming we're at year end 23, right? They've got 30 million in revenue. They've got $1.5 million in cash. They've got an 8% EBITDA margin, right? So that's net income plus depreciation plus amortization here because there's no interest expense, right? We have no debt. They own the properties. There are 2 locations. They own property at both, right? That's been appraised at $10 million, right? And there are 3 owners in this, right? And each owner has a 33 1/3% stake. We're looking at a buyout starting next year, right? So what does that look like, right? So first we need to know a value. If we don't know what something's worth, the rest of the work really isn't that useful. So this is a very easy, quick calculation. This is not necessarily what your business is worth, but let's look at the EBITDA margin. Let's take a multiple. 4.5 times for 8% is not bad right now. 4.5 times that 2.4 million. And then in any buyout, what we need is equity value. EBITDA times the multiple gives you what's called enterprise value. To get to equity value, we need to subtract debt and we need to add cash. And this is important because a lot of people will ask us, well, I've got a lot of cash on my balance sheet. What happens to that? Well, that's part of your value you're walking away with. And so pulling some of that out into a reserve fund can make a lot of sense because it's your money anyways. Right? You're going to get paid out regardless. But if you pull some of it out and set it aside to pay you off later, that can be a really good strategy because you're helping to protect some of that cash as opposed to leaving it in the business and potentially then maybe it gets put to another use besides the buyout, right? And so the important thing here is the entity. If you own the real estate and the business in the same entity, then your buyout is all of the value of that entity. So that is the business plus the real estate, $22.3 million, right? This becomes important later. So if we're buying out a third, right, it's a little under $7.5 million, 33%. And let's assume we're doing it on this 10% down from cash on hand, 5-year note for the remaining 90%. And the interest rate is set at the prime rate, right? This is what the prime institutions lend to each other, which is 8.5% as of right now, plus 2, so 10.5%, right? Loans are a lot more expensive. So that's part of the reason that multiples are lower, right? Interest rates go up, they tend to bring the multiples of people are willing to pay down because money is not as cheap. Right? And so you're looking at an annual payment of $1.725 million. Now, a lot going on here in this slide, but these are the types of projections you want to make. And once we're done with this presentation, we are going to provide a little cheat sheet along with the slides to Rick and the folks at LBM Journal so they can send it out and people will have some context here. But what you're really looking at are 3 things. What is my cash balance? What is the interest and principal that I'm paying on the note, right? The interest is going to get picked up there in the red line as part of your income statement. But really important is that bottom line. What is the net profit after financing payment? All right. What is the net profit after financing payment? And what that is is the ability of the company to pay not just the interest, but also the principal on the loan. The interest plus the principal on the loan. And that becomes important because it's going to impact the cash that is available to run your business. And like we said, the buyout is expensive, $1.725 million per year for 5 years. And so what we need to do is we need to run some forward-looking projections to figure out what can be done sustainably. And yes, your cash will likely go down in year 1 because you're putting a certain amount down as a down payment, right? But we want to see operations that can help enhance the value of that cash over time, right? We shouldn't be draining our cash to buy out an owner because that means we're probably operating at a loss. We couldn't afford the loan to begin with. So now let's assume that you have real estate in the picture. And there are lots of different ways this can go. We're going to give one example here, but again, ask questions, reach out to us. We can go through your specific example. But if you own the real estate and the business under the same entity, ABC Lumberyard owns both the business that sells lumber and millwork products, and it owns the real estate. As we talked about in the last slides, all of that value has to be bought back. Well, what happens if instead you said, well, I'm gonna separate the business. I'm gonna separate the business from the real estate. Right? We're gonna move the real estate into a separate LLC. The LLC will be owned in the same percentages that the business is owned. And we don't have to buy out, excuse me, the owners necessarily from the real estate entity. We can allow that real estate entity to operate and collect rent, and that can be a way that the departing owner or owners can get some cash flow from the business over time. And then maybe there's an age limit that you set and say, hey, after 75, then we have to buy them out of the real estate. But you know, there are lots of ways to structure this, but now you're talking about buying out a business at only 12.3 million total value or 4.1 at 33%. Now, of course, you have to deal with capital gains taxes. And here we're assuming that there's going to be about 1.67, 1.66 million in capital gains for moving that real estate into a separate entity. And again, the reason that this strategy can work now is because people are sitting on a lot of cash, right? And this is an investment, right? You're making an investment by paying some taxes to move the real estate out to help separate that real estate from the operating business to provide ongoing cash flow for the owners of the real estate, the family, so that regardless of who owns the operating business, there is still cash flow to the real estate that is owned by the family. So if the lumberyard moves or it's got a third-party owner, you aren't completely out of it. You still have an asset that's creating cash flow. And so this is going to look, again, a little bit different here in the buyout piece, which is we are going to be putting quite a bit more cash down up front, but we're also going to have higher net cash after financing payment because we're not having to spend nearly as much on interest and principal, right? If we go back and look at that last slide, here we're under $1 million. About $952,000 is your payment as opposed to 1.725. And so, yes, you're going to have to pay some taxes up front on spinning the real estate out. But now that return is you've got the real estate in a separate entity, which many folks already do. And that's wonderful. That's the way you should want to set it up. And you've got a lower buyout price for the business. And so that means you've got cash free to do other things, expand operations, invest in technology, bring on new management, all of these good things. So now let's talk a little bit about protection across different ages. This is really, really important because we do end up in family type businesses. Even if it's the same quote unquote generation, we may end up with owners with a 10, 15-year spread between the oldest and the youngest. Imagine we had 3 or 4 owners in the family, and they were from the mid 60s to their early 50s. The owner in the early 50s is going to have a much, much different outlook, needs, goals than the owner in the mid 60s. And so we have to solve for these problems, and it's easier to do it with some time and with some planning than, oh my goodness, the 65-year-old has a health issue, or the 50-year-old has a health issue or a family crisis, and they need out. They need money now. And that's what we're trying to guard against. All right. So succession planning. This is the key. All right. Find out what the business is worth. Then let's start looking at the options. But do I have children interested in the business? Have you even asked? All right. A lot of people will say, nah, I don't think my children are interested. But let's actually have a conversation, right? Let's sit down and have a conversation about that. Are there key managers who we think could take over? Lots of times it's not a one-for-one replacement. You don't just find one person to replace one owner. Maybe two people, maybe three people. Right? What about your competitors? What's going on in your area? Talk to your purchasing group. Right? A lot of them have, if not their own arm, like a Nation's Best, that will potentially buy good run businesses, but they may have other connections that folks you could talk to. And then this idea of worker ownership, right? And there can be some big tax advantages here for the seller and for the business if it's structured right. And again, you're selling the company to the employees that know your business, right? That know the culture, they know the customers. And I think an important point to make here about employee ownership is you're not giving the forklift driver in your yard keys to run the business. It still needs to have a strong management team. In fact, I'd say that with employee ownership, it's super important that your management team is in place, is able to be there for 10 or 15 years, because you do need ongoing strong management that then teaches the next and teaches the next. And so when you do the employee ownership route, you're not just giving up on the business principles. In fact, you need to have very strong business to do this. The tax breaks and those areas that can help you are just a benefit of having a well-run business. And finally, that's, balancing the financial and non-financial interests of each owner, right? Really, really important to balance those, because some of these may be monetary. I need a certain amount that I feel like I need, or I talk to my advisor, this is what we need to retire. And non-financial interests can be things like, I'm worried about what happens, for example, if I have a minor child and I die, or I'm in a coma. What if they're interested in the business, but they don't know it yet? And how do I protect their ability to get involved in the business? So talking through these things is key. Then it gets to the implementation, right? When do I want to start? Do I want all out at once? Am I going to go over time, 30% here, 30% there, 40% the final year? Are there strategies I can use? Maybe I don't need all of the money. Can I gift it to a family member, grant it to a key employee? And then thinking through, what are the taxes? And if I'm selling the stock of my business, I'm probably just getting taxed at capital gains. If it's an asset sale, like typically happens if you're bought by a third party, there's going to be a mix of ordinary income and capital gains taxes. And what benefits the buyer doesn't benefit the seller, meaning that the buyer is going to want to take on assets that are going to cause the seller to have to pay ordinary income tax, because those assets are easier to depreciate. They can be redepreciated. And so these are things that you need to think about and communicate and negotiate. And then finally, what derails a lot of these is just transition of leadership and management. You have to have a strong team in place, and the knowledge has to be passed on. There has to be mentoring that's going on in the business, so that what you know as the owner doesn't leave with you. And finally, the legal documents, right? These are the things that aren't important until they are. And this is both on the personal and the professional side. So do you have a will in place, right? Does your spouse have a will in place? Do you have powers of attorney and medical directives? Do you need to consider putting together a trust or multiple different trusts to help? Do you have a professional will? And this is an important document it's not going to be filed with the clerk like your last will and testament. But this says what happens to the business if I got in a car crash and was in a coma. Who takes over my responsibilities? Who has access to the passwords? who can get a loan from the bank if we need it, right? These are very, very important documents because what you're trying to be is transparent. Part of that planning process is being transparent with the important decision makers. All right, and then a buy-sell agreement. Even if you're a sole owner now, if you plan on taking on a partner, a younger partner, or a younger family member, or transitioning out over a period of years, when there are multiple owners in the business, you need to have that buy-sell agreement, right? It's your prenuptial for your business, right? We got into this. How do we get out of it? At what value? What triggers a buyout? What's the date that the business is valued? What value is calculated? Is insurance able to be used to help with a buyout or to help as collateral for a loan? Lots of these things need to be thought through and then memorialized so that you're in a position where if something happens, the business is not going to be hamstrung. So let's look at an example. Last example here. And this is what we talked about earlier. We've got a spread in the owners, right? This is back to those three owners. Let's assume those three owners from the first two examples. They're 65, 59, and 53. The 65-year-old he's ready for the exit, right? Next year or two. But everybody's got different concerns. The older owner is going to say, well, yeah, of course I want to take risk off the table. But at the same time, if I sell out now and the business just keeps growing, the value of the real estate just keeps going up, well, I could have gotten more money if I had just waited. So what is my incentive to get out of the business now if I think I can get more money later? The middle owner is thinking eventually about his succession, but he's also concerned about the operations, the sustainability, and then how do we fund my older brother's buyout here? And then the younger owner, he's the one with the longest time horizon, right? He's worried about things like, geez, we're going to have to buy out the 65-year-old at this price. Man, if things even go up by 4 or 5% over the next 6-7 years, we have an even bigger cash flow issue when the middle child wants out. And Lord knows what it's going to be when I buy out. So each of these people has different concerns, and you have to solve for them different ways. Insurance is a helpful way to do it. Get that business valued every year so that you know how much insurance you need. Make sure you're setting a value that is fair and everybody understands it. For example, if you've got a bunch of minority owners, well, maybe the buyout is going to be at whatever the estate or gift tax would be, so you can apply some discounts there. Still means they're taking away some money, but the discounts help control the price. Moving the real estate out. That then allows the older owners to not feel so bad about, well, geez, I could be giving up 10 years of growth in the value of this business because I have to sell out now as opposed to my youngest brother. Well, if they can participate in the ongoing cash flow of the real estate, hey, that's a great way to help everybody get on the same page, understand some of the limitations, but also experience some of the ongoing benefits. Finally, what steps should I take right now, right? This is what we tell everybody. It's the ABCs. Praise the real estate, value the business. Right? You have to know where you stand today. Even if your real estate and your business are in separate entities, know where you stand because that's the basis for any planning, right? Then you do the B, build your succession plan. What are my options? What do I need from the business? How do I turn it over? Who are my managers? Who are the people I need in place? Do I need insurance? Do I have the right legal documents? Is everybody protected? What is everybody's goals? These are all things that need to be discussed and then memorialized either in a legal document like a buy-sell agreement or in internal documents that are shared between folks. And then it's calculate that net worth. Right? What is the net worth? And net, of course, meaning what is it after paying off debt, paying taxes that I'm going to have, and then making sure that do I put things in a trust and so that my kids are protected, my spouse is protected. Have I thought about that? Do I have the right will in place? When was the last time I updated these documents? And so these are all things that from our perspective, we bring this all together, right? We can value the business, we put the succession planning together, and then we can work with your specific advisors, bankers, attorneys, CPAs, maybe an M&A person, to make sure that all of this works together, because it's a lot going on here, and we know that everybody's busy. And so you don't want to have to turn into your own succession planning advisor. There's too many specifics going on underneath, and you only do this once. So we don't want to miss any opportunities or end up in any trouble, especially when it comes to the tax side of things. So, as I said up top, please feel free to reach out to us. We are happy to help at any stage of the process, but earlier is better. Right? Valuation is good. Develop and implement that succession plan and coordinate. Okay? All of those things are really important. So reach out. We'll send these slides out. I'll send them to Rick after this, and we will be happy to talk to anybody. We'll also send that little cheat sheet so that if you're looking through here and you're looking at those two different buyout scenarios, you can have a little bit of an idea of, oh yeah, that's right, that's what these things are talking about. But as always, we're happy to help. So with that, we'll turn it over for questions.
Awesome. Thanks, Sam. I again, I learned a ton in this. And we're going to be going through something similar here at LBM Journal as a business with needs to make a plan. So
Sure.
So thank you. We have one comment and 3 questions. First, the comment. Comment, not a question. As the owner of a company that's just about to begin the succession planning process, the info you shared today is gold. Between your webinars and John Wagner's columns in LBM Journal, we've learned a ton about navigating this process. Thank you.
My pleasure. My pleasure. That's great to hear. Thank you very much.
Okay, I understand the idea of creating a reserve fund, but how do I actually implement that? Do you recommend opening a savings account that's linked to our business checking account?
That's a good question. So that's a possibility. That's certainly a possibility. What I would say is you want to earmark those funds for the specific purpose and then segregate them so that they don't end up getting used if we need to upgrade our fleet or we need to expand the warehouse, right? This is for a very specific purpose. And so, a separate savings account would work. I would say what we have found is a little bit better is that idea of creating the separate, call it buyout fund LLC. It's owned by the same owners as the business, and then taking that and conservatively investing it, right? Money market funds, CDs are great right now. And it's the one thing about interest rates being high is that it's better for savers. And so you don't want to go and dump the money into stocks, right? Because you want to have stability. But at the same time, moving that money out of the business, it gives it that separation so that you don't necessarily dip into it if you think, oh, geez, well, it's only $100,000 here, $100,000 there, right? And so we would say, think about that separate LLC. Go ahead and look at a money market fund, right? It's government obligations, stable. And then you've got that money there, but it is separate from the operations. I think that's probably the better way to do it.
All right. Another question. What if some of the owners are close to retirement and some are on the younger side and have very young children, so they have no way to determine if they may be interested in the business? How do we navigate planning for succession under those circumstances?
Yeah, that's a really good point. And we're working with a couple different clients on that right now. And again, that gets back to that example of the 3 different ages of the owners, the hypothetical example we gave. The 52-year-old may have kids that are in high school or college, right? They haven't even begun to think about what's going on. So I would say it's kind of a 3-step process. Number 1, the owners need to sit down and think through what are the requirements, what are the criteria for children to be considered for ownership. Is it a certain amount of time working in the business? Do they have to spend time working outside of the business to gain knowledge elsewhere? Do they need to have a certain level of education? So the owners need to come up with their internal ideas of what children have to do to reach that threshold of owner or not owner. So I think that's first. Number 2 is the owners need to get a good idea of where each of their children is age-wise, right? The oldest one may have kids that are, they've already said they're out of the business. Okay. So we can kind of strike that out. But maybe some people are thinking about it who are older but haven't yet made a decision one way or the other. Maybe they haven't reached the threshold yet. And so keeping kind of a running tally of who's out there and updating conversations with them becomes really, really important, because we want to make sure that everybody feels heard and we're not leaving anybody out in that potential situation. Especially if they're in those in between, they're in their mid-20s, they've got to have 5 years of work experience, and then maybe 3 years with the business if we're considering them for ownership. So those people need to get thought about. And then for younger folks, a couple things to think about here, and this is where the idea of trusts would come into it, right? And you would say that, let's say that in this example you have an owner in their early 50s who dies, and their shares then are held in trust. The trustees of the trust are the other owners, and there are stipulations in the trust, right? The kids have the same requirements as anybody else in terms of whether or not they can be owners, and then the trust will sunset at some point, right? So we don't end up with a trust that just perpetually gives potential ownership to children who might never take advantage of it. And so, there we're balancing the needs on both sides. And by allowing the owners who are left to be the trustees, that also gives them some oversight power into how are these folks developing, where are they going? And then eventually, if that trust sunsets and the kids don't decide to come in, well, then the shares, get bought back by the company at, again, it would be you would have to think through how you would want to do that, but you'd set it up in a way that made it so it wasn't terribly punitive to the company. So a lot of stuff to think through there, and that's why it's really good to map all of this out and then start getting to the specifics.
Right, that sounds good. It's good to know that the process can be really fluid too, as long as you plan for it.
Yeah, absolutely. Great point.
Okay, how frequently should we update legal documents? And how do we determine if we need a trust?
Yeah. So legal documents, I would say you should review them every 1 to 2 years, or when a material event happens. So a material event would be something like a new owner, right? You gift 20% to your son or daughter. That's a good time to go relook at all of the legal documents, right? But you want to be doing it at least biannually. So, every other year, I would say. And it's not a common practice for a lot of people. They had a shareholder agreement written 35 years ago, and it may, we've read shareholder agreements that say that the value will be calculated by their accountant who hasn't been in business for 20 years because they were the accountant of the last generation. And so little things like that are typically what you're looking for in these updates of these documents. So I would say definitely do that. It may not require any update, but it is important to think about that. And then I would say that trusts can be important in a couple different scenarios. Number one is if you feel like you have a lot of potential assets to protect, right? Typically, the first thing you would put into a trust would be things like your house, maybe you've got a brokerage account somewhere, things like that, right? Because the trust is just going to talk about how do I administer the assets if something happened to me, right? If Rick was the trustee of my trust, if I died, how would those assets get administered? Who would they get? Who would have access to them? Maybe there's a payout to somebody. So it's important on the personal side. Where on the business side, it becomes important is when you've got, let's say, multiple owners or owners with children, like we talked about before, and how are shares of the business going to be passed along to those folks, or maybe held in trust until they're of a certain age or they've met certain qualifications. So that's where it would be on the business side. And it may be that you need multiple trusts, one for personal, one for professional. So that's another consideration here as you're thinking through that specific legal document.
All right, and we have one more question. How does ending tax laws affect plans? And I wonder if that means, like, how do changing tax laws affect succession plan?
Yeah, I think so. And perhaps what they're referring to is if there's no action in Congress by the end of 2025, starting January 1, 2026, all of the current estate tax levels will be cut in half. And so instead of, I think right now it's 25 or 26 million for a married couple filing jointly that they can gift in their lifetime without having any issues with this with estate taxes. Well, if that got cut to 13 or 14 million, it's going to adjust for inflation, so it's probably going to be higher in 3 years. Hopefully not much higher, right? Hopefully inflation won't be too out of control like it has been. But I think that's part of this, is that it's important to look where you are, and that's where that C of the ABCs, calculate your net worth, becomes really important, because you need to know where your net worth sits. If your net worth is sitting at 8 or 10 million and you're married filing jointly, you probably don't have too much to worry about. But if your net worth is 20 plus million, then it's definitely time to start planning, because you could end up in a scenario where if you don't start moving some of those assets, whether they're liquid, illiquid, personal, business, outside of your estate, you could be on the hook for a pretty big tax bill. And while lots of states have gotten rid of their state level estate tax, the federal estate tax can still be very punitive. I believe it's 40%. And so, 40% of $3, $4, $5 million, that's a big tax check your family has to write. And the concern there, of course, is liquidity, right? If the real estate in my business are the bulk of my assets, and I have to write a $2 million check to the IRS if I died suddenly, where's that $2 million coming from? And again, that's where the insurance piece comes into it. But the insurance has to be in place, and you have to set up what can the insurance be used for, because if the company took out the insurance, then the company's not going to use that $2 million to pay taxes. They're going to use that insurance to help with the buyout. So the family's going to potentially need to take out some insurance. So lots of moving pieces here. And like you said, Rick, it's fluid. And that's why all of this stuff needs to be discussed and thought about. And even within a succession plan, it will change, right? 3 years is a long time.
Right. All right. And we are out of time. So thanks everybody for
Excellent.
joining us. And Sam, thank you. This is great.
Yeah, my pleasure. This was great. Thanks everybody for listening in.
Yeah. So watch for the if you registered, which you did because you're here. So watch for the email from us that's going to have the Sam's PowerPoint, as well as the link to the recording. And I'm not sure when our next one is scheduled, but I'm sure we have one coming up. So we'll see you next time.
Yeah, that sounds great. And I'll see anybody out there in a couple of weeks. We'll be in Charlotte for Rick and LBM Journal's big conference.
That's right. Yes. Which, yeah, your mug kind of reminded me of that. Your LBM strategy. Yes. Yeah. So there's still time to register for LBM strategies. You can meet Sam in person, as well as Rick Davis, Thea Dudley, lots of people, and we have 30 people taking the stage this year. It's going to be pretty incredible. So it's going to be a great show. lbmstrategies.com. And that's it. So we'll see you next time.
Great. Take care. Thanks, Rick.
Goodbye.
Bye.